For decades, retirees have been told the same story: Social Security is a benefit you can rely on, and someday it will be completely tax-free. 8. It's a promise that brings hope to millions who worked hard their entire lives. But here's the harsh truth. What was promised and what actually happens are two very different things. Policies have changed, partial measures have been introduced, and loopholes have crept in, leaving many retirees paying far more than they expected in taxes on the very benefits meant to support them. Today, we're going to dive deep into the reality behind Social Security taxation. We'll uncover how current policies impact your retirement income, reveal the hidden costs most retirees never see coming, and show how strategic planning can protect your benefits, even when government promises fall short. If you want to truly understand how to maximize your Social Security and avoid costly mistakes, this is the guide you need. The original promise vs reality. For decades, Social Security has been promoted as a safety net for retirees, a benefit designed to provide financial security after a lifetime of hard work. Over the years, politicians have repeatedly promised to make Social Security completely tax-free, reassuring retirees that the money they earned would belong entirely to them. These promises created a sense of confidence and trust, encouraging millions to rely on Social Security as a cornerstone of their retirement plans. But as many retirees have discovered, the reality is far more complicated and far less comforting. The original promise of tax-free Social Security was simple, and appealing benefits earned through decades of work should not be subject to federal taxation. It seemed logical. After all, the system is funded by payroll taxes paid by workers, so why should the government tax benefits that were already earned? This message resonated deeply with retirees who had spent years budgeting, saving, and planning around the assumption that Social Security would remain untouched by income tax. It became a key pillar of retirement confidence. However, the reality is much different. Instead of being fully tax-free, Social Security benefits are partially taxable based on what the IRS calls combined income, which includes wages, retirement account withdrawals, interest, dividends, and other income. Depending on your total income and filing status, up to 85% of your Social Security benefits can be subject to federal taxation. For many retirees, this is a harsh surprise, especially when combined with other financial obligations. Suddenly, the money that was supposed to provide security is being partially diverted to taxes. The discrepancy between promise and reality has significant consequences. Many retirees planned their budgets and withdrawals assuming their Social Security would be fully tax-free. When taxes are applied unexpectedly, take-home income is reduced and financial plans must be adjusted. This can affect everything from monthly living expenses to long-term investment strategies, forcing retirees to make difficult decisions about spending, saving, and withdrawing funds from other accounts. Another layer of complexity comes from political action and partial measures. Over the years, policymakers have introduced tax relief measures and proposed changes, sometimes reducing the taxable portion for lower-income retirees or adjusting income thresholds. While these measures offer some relief, they are far from a complete solution. Many retirees remain fully exposed to taxation, and promises of tax-free Social Security continue to fall short. This partial relief often creates confusion, with retirees unsure exactly how much of their benefits will be taxed and when. The psychological impact cannot be ignored. Retirees who believed in the promise of tax-free benefits often feel misled and frustrated. Trust in the system is eroded and financial confidence suffers. For many, retirement was supposed to be a time of stability and peace of mind, yet the reality of Social Security taxation introduces stress, uncertainty, and financial pressure that was never anticipated. The takeaway is clear: the promise of tax-free Social Security was appealing, but the reality is that most benefits remain partially taxable. Retirees must understand how combined income rules work and recognize that government promises, while comforting, do not always reflect the practical outcome. By acknowledging the gap between expectation and reality, retirees can take informed steps to protect their income and plan effectively for the years ahead. At the end of the day, understanding the difference between promise and reality is the first step toward taking control of your Social Security benefits. Awareness allows retirees to prepare, strategize, and minimize the impact of taxes, ensuring that they keep as much of their hard-earned money as possible. How current policies impact your retirement income. Understanding Social Security taxation isn't just about knowing the rules. It's about understanding how those rules directly affect your take-home retirement income. While politicians have promised tax-free Social Security, current policies tell a different story. For many retirees, these rules mean that a significant portion of benefits is subject to taxation, sometimes unexpectedly, which can drastically reduce disposable income and disrupt long-term financial planning. The key to understanding the impact lies in how the IRS defines combined income. This isn't just your Social Security benefit. It includes other income sources such as wages, pensions, dividends, interest, and withdrawals from retirement accounts like IRAs and 401ks. Depending on your total combined income, up to 85% of your Social Security benefits can be taxed. This means that even retirees who are counting on Social Security as a fully reliable, tax-free income stream may suddenly find themselves paying hundreds or thousands of dollars in taxes each year. Take, for example, a retiree who receives the $20,000 earned annually from Social Security and also withdraws $10,000 from a traditional IRA. 8. Their combined income pushes a portion of their Social Security into the taxable range. What they thought was guaranteed, untouchable money is now partially taxed, reducing their effective income and forcing them to reassess spending, healthcare costs, and lifestyle choices. For retirees on fixed incomes, this can have a profound impact. Current policies also create what many call the tax trap. Because taxation is based on combined income, additional withdrawals or income, even if necessary, can trigger higher taxation on Social Security. For example, selling an investment or taking a distribution from a retirement account to cover an unexpected expense can push a retiree into a higher taxable range, inadvertently increasing the tax burden on benefits that were previously untaxed. This interaction makes planning withdrawals more complicated and increases the importance of timing and strategy. Partial relief measures introduced in recent years help some retirees, but often fall short of expectations. For lower income retirees, certain thresholds reduce the taxable portion of Social Security, but these adjustments rarely make benefits fully tax-free. Many middle-class retirees who assumed partial tax cuts would fully protect their income are surprised to find that their Social Security is still heavily taxed. The result is frustration, financial strain, and the need for careful planning to minimize the impact. The indirect consequences of these policies are equally significant. Taxation of Social Security can also influence Medicare premiums. Higher reported income may push retirees into higher Medicare Part B and Part D premiums, further reducing net income. Combined with property taxes, healthcare costs, and everyday expenses, the tax burden on Social Security can erode the financial security that retirees assumed would be guaranteed. This is why strategic planning is so important. Understanding the rules allows retirees to structure income sources, time withdrawals, and leverage deductions to minimize taxation on Social Security. For example, managing withdrawals from tax-deferred accounts, coordinating with taxable investments, and taking advantage of allowable deductions can reduce combined income. 8. Ensuring that more Social Security remains untaxed. Without this planning, retirees may unwittingly give up a substantial portion of their benefits each year. The takeaway is clear: current policies don't align with the promise of tax-free Social Security. While partial measures provide some relief, the impact of combined income rules, taxable withdrawals, and interactions with other benefits can significantly reduce take Home income. Retirees need to understand the real-world consequences of these policies and actively manage their finances to protect their benefits. At the end of the day, knowledge is power. By understanding how current policies impact Social Security, retirees can plan strategically, minimize taxes, and ensure that they keep as much of their hard-earned money as possible. Awareness transforms frustration and uncertainty into control and confidence, turning policy pitfalls into opportunities for smarter retirement planning. Hidden costs and surprises retirees are often missed. When retirees think about Social Security, they usually focus on the obvious, the monthly benefits they'll receive. But what many don't realize is that taxes are just the beginning. Even if you understand that a portion of your benefits is taxable, hidden costs and surprises can quietly erode your retirement income, leaving you with far less than expected. Understanding these less visible factors is critical for anyone relying on Social Security as a foundation of retirement security. One of the most common hidden costs comes from Medicare premiums. Medicare Part B and Part D premiums are income-based, which means that higher reported income, like withdrawals from IRAs or taxable investments, can push retirees into higher premium brackets. In other words, even if Social Security itself is partially taxed, additional income elsewhere can indirectly increase healthcare costs. Many retirees are blindsided by this, realizing that their take-home income is reduced not just by taxes on benefits, but by higher insurance premiums as well. Another surprise comes from the interaction between Social Security taxation and retirement account withdrawals. Traditional IRAs, 401ks, and other tax-deferred accounts are subject to ordinary income taxes when withdrawn. These withdrawals count toward your combined income, which can increase the percentage of Social Security subject to tax. Without careful planning, a retiree might withdraw funds to cover living expenses, only to find that a significant portion of Social Security is now taxed, creating a compounding effect on their overall tax liability. Even safe sources of income, like interest from savings or dividends from investments, can trigger unexpected taxation. Social Security taxation isn't calculated in isolation, it's based on total income. Many retirees fail to realize that a small increase in income from investments or part-time work can unexpectedly push them into higher taxable ranges, turning what seems like harmless extra income into a reduction of net benefits. Additionally, some retirees overlook state-level taxes. While federal rules determine the taxable portion of Social Security, certain states impose additional taxes on benefits or include them in state income calculations. The combined effect of federal and state taxation can be substantial, and for retirees moving between states or planning relocation. 8. These hidden costs can significantly affect retirement budgets. Even planning for emergencies can have hidden costs. Suppose a retiree taps into savings or investments to handle unexpected expenses. These withdrawals can increase combined income for the year, resulting in higher Social Security taxation and even potentially affecting eligibility for other income-tested benefits. Many retirees only realize this impact after the fact, leaving them scrambling to adjust budgets or cut spending. The psychological toll of these hidden costs is also significant. Retirees who assumed their benefits were largely protected may feel frustrated, stressed, or misled. Financial plans created around promised tax-free benefits can be thrown off track, forcing difficult decisions and lifestyle adjustments. Understanding and anticipating hidden costs can prevent these surprises, reducing stress and allowing retirees to maintain confidence in their financial plans. The key takeaway is this: Social Security taxation is only the tip of the iceberg. Hidden costs, ranging from Medicare premiums to indirect taxation effects, state taxes, and interactions with other income, can quietly erode retirement income. By identifying and planning for these factors, retirees can minimize surprises, protect take-home benefits, and create a more reliable and stable financial future. At the end of the day, knowledge is the greatest tool for protecting Social Security. Recognizing hidden costs turns uncertainty into clarity and frustration into actionable strategy. Retirees who understand the full picture of taxes, premiums, and income interactions are empowered to make smart financial decisions, keeping more of their benefits and building a retirement that is secure, predictable, and free from unwelcome surprises. Strategic planning to minimize taxes and protect benefits, understanding social security taxation and hidden costs is one thing. But knowing how to protect your benefits and minimize taxes is where retirees can gain real control over their financial future. 8. Strategic planning isn't about avoiding taxes entirely, that's rarely realistic, but about making smart choices that reduce liability, maximize take-home income, and preserve financial security. The first step in effective planning is understanding the rules. Social security benefits are taxed based on combined income, which includes wages, retirement account withdrawals, dividends, interest, and other sources. Knowing how these factors interact allows retirees to make informed decisions about when and how to withdraw money. For example, delaying withdrawals from traditional IRAs or 401ks until necessary can keep combined income lower in the early years of retirement, reducing the percentage of Social Security subject to taxation. Timing is crucial. Strategic retirees can orchestrate withdrawals and income streams to stay below taxable thresholds. By carefully planning how much to withdraw each year, you can avoid inadvertently pushing Social Security into higher tax brackets. This is particularly important for retirees with multiple income sources like pensions, part-time work, or investment portfolios. Even modest adjustments in timing can result in significant savings over time, ensuring that more benefits remain untaxed and available for living expenses or reinvestment. Another powerful tool is leveraging deductions and tax-advantaged accounts. For example, charitable contributions, medical expense deductions, or health savings account (EHSA) withdrawals can reduce taxable income, indirectly protecting Social Security from higher taxation. Roth IRAs also play a strategic role. Withdrawals from Roth accounts do not count as income for Social Security taxation purposes, providing a valuable way to access funds without increasing the taxable portion of benefits. Using these tools wisely allows retirees to create a more tax-efficient retirement strategy. Investments themselves can be structured strategically. Taxable investment accounts with long-term capital gains treatment, municipal bonds, or dividend-optimized portfolios can generate income that minimizes impact on combined income, preserving Social Security benefits. Retirees who proactively consider how every dollar of income interacts with Social Security taxation can make smarter, more efficient financial choices. Planning also extends to Medicare and other income-related costs. Higher combined income can increase Medicare premiums, further reducing net benefits. By managing withdrawals and income streams strategically, retirees can keep reported income within optimal ranges, lowering premiums and maximizing the net value of Social Security. Small adjustments in income reporting or timing can save hundreds or even thousands of dollars annually. Beyond taxes and premiums, strategic planning gives retirees peace of mind and flexibility. It turns a system that might feel confusing or punishing into a framework that works in your favor. By understanding the rules, coordinating withdrawals, leveraging deductions, and optimizing investments, retirees can maintain control over their income, preserve benefits, and ensure financial stability throughout retirement. The overarching takeaway is clear. While government promises may fall short, retirees are not powerless. Strategic planning empowers you to minimize taxation, protect Social Security, and maximize disposable income. It transforms uncertainty into control and allows you to enjoy retirement without constant worry about taxes eroding hard-earned benefits. At the end of the day, the difference between a stressful, reactive retirement and a confident, financially secure retirement comes down to strategy. By understanding the rules, planning carefully, and taking deliberate steps to protect benefits, retirees can turn the system to their advantage. Smart planning ensures that Social Security delivers on its promise as much as possible, even when government policies fall short.